I avoid new development, so I'm the perfect person to educate on why that's actually advantageous.
Here in Florida, a lot of the areas, the builders did very well building emotional properties. Now, emotional properties for me, Christina, are properties priced 2 times the median average for the area or a little bit more.
The second half of last year, I bought 3 apartment buildings, 10 unit, 14 units, 22 units. They're tiny, tiny buildings. They're relatively easy to manage in my world because I'm very familiar with that asset. I understand the complexities of those properties, and those are not my favorite properties. I will buy a B-. I absolutely will. I'm happy to do that, especially in a neighborhood I see as regentrifying. I will intentionally enter into a neighborhood like that.
I am Christina Suter, and this is the Real Estate Breakthrough Show, where we talk about the reality of real estate, the mindset you need in order to face the reality of what it is, and tips and tricks to get you moving forward in investing. I am your host, Christina Suter.
Hey you, this is Christina Suter with Real Estate Breakthrough. I have Jim Sheils with me with Southern Impression Homes. I invited him to the show because I feel like he is an unusual guest for me in that he really focuses on what he calls build to rent, but there's a whole different understanding on that I feel like he brings to it that isn't really what you think it is. Also, he's pretty knowledgeable in what's going on currently in that whole space and where he is. And I really want him to download his expertise to us to help educate us and get a sense for what is it that we need to know. As you guys know, I am a long-term buy and hold. I do midterm, short-term, long-term rentals, but I own my units and hold my units for, if possible, 20 units, 20 years or more. I'm too old to keep flipping things anymore, guys. I've been there, done that. I'm too old. I don't want to do that. I want to build a legacy portfolio. So that's what I'm up to. And Jim, I think, has some good points for us and some good education. So Jim, welcome to the show.
Thanks for having me, Christina. Good to see you.
Tell us about your background a little bit. Give people an understanding of what it is, where you started, and what it is you do.
Well, like you, I'm getting too old to flip. So, but 27 years ago in Central California, I bought that first fixer-upper in Lompoc, California, and kind of haven't looked back. Did a lot out in Bakersfield with HUD foreclosures, and then in the early 2000s moved to Florida to be around where I thought that some good growth patterns were. So I've been a real estate investor for 27 years. The first 15, 16 years, I think I was just trying to get my bearings. And then really a lot of my wealth, although I created great wealth in those 16 years, almost lost it in 08, like most of us. It was not an easy time, but we survived. And coming through that, there were great opportunities in foreclosures. But as that market began to change years and years after 08, about 10 years ago, we went into something called build to rent, which wasn't even a term, which just meant we were building new construction properties with the purpose of renting them. Right. And that was something I kind of fell backwards into with my now partner. But we've been able to span from Northeast Florida to all of Florida to several states now, and have a large Japanese partner helping fuel this. And we work with over 1,000 individual investors and a good number of institutional buyers who want us to build what they consider the most advantageous rentals available today.
Okay, why do they consider them to be the most advantageous? I think that's helpful for people to understand why. I avoid new development. So I'm the perfect person to educate on why that's actually advantageous.
Yeah, no, look, not all new development for the investor mindset is there, because remember, there's the investor mindset and there's the emotional mindset.
Right.
For example, here in Florida, a lot of the areas, the builders did very well building emotional properties. Now, emotional properties for me, Christina, are properties priced 2 times the median average for the area or a little bit more. They don't cash flow, but hey, they're beautiful. You're able to get these low interest rates. And they, people said, oh, I'll lose money every month and, make it up in equity. Those were the emotional things. Now for the builders, those were great. Those are the biggest spreads. And then there's the silly, unsophisticated builders like us that said, well, we'll do the less sexy properties that have better fundamentals and just do volume. And that's always been our model. And the reason why a lot of the institutions are seeing this as the best unfair advantage type properties now is because even in that boom of, end of 19 going through the pandemic, there was ignorance to the affordable properties, the workforce housing. So as you hear about these shortages, Christina. And they're saying, and look, I'll be the first to tell you, there's areas of Florida where it has settled back down. There's growing inventory, but you have to segment the markets. Are those the emotional properties or the workforce housing that was underbuilt? So we're continuing to build in like Central Florida right now. We're building very aggressively because the growth patterns are still there. There's still a housing shortage, and nobody wanted to focus on the houses under 300,000 or duplexes, under 400,000. And so most of the institutions we're seeing, they're sticking to these starter homes, townhouses, smaller unit cottages to be able to cash flow. And also there's such a need for this affordable housing. And that's the need we try to fulfill and focus on.
Jim, I knew you would have the answer. I knew you would. When I set up the question, I'm like, he's going to have the perfect answer for this, because I think I and a lot of other investors are so desensitized to, here's a great property. This real estate agent says it's beautiful and it's well done and it's been rehabbed to the T's and and you can buy it at top dollar. And I'm like, I don't rehab or built, to be accurate, built. And I'm like, I don't want that property. That to me doesn't serve my long-term. It doesn't even necessarily even serve my midterm or short-term tenants.
Yeah.
Right? Like, I'm really looking for something where I can buy in at a price point where my net income is maximized. And that's important to go, like, it's not so much that I buy in the cheapest neighborhood or the most expensive neighborhood, right? Because people think that there's a direct relationship between the price point that you buy it at and the rents you're going to get for it. And that's not true. There's not an equal correlation between those.
Yep.
Right? So sometimes if I take a stair step down from the top properties, like you said, it's regional and asset specific. If I take a stair step down from the top properties and I buy something that's just under, or buy a mid-range property, as an old mentor of mine used to say, a good property in a good neighborhood with good tenants, right? Just like a work class, basic, people earning a good living. Those properties cost me less to buy in, and my rents actually end up giving me a higher net income at the end of the month, return on equity, because of the amount of money I put into it and the amount of my loan is. So there's this, as an investor, to me, there's a huge advantage to looking at workforce housing, looking at mid-level housing, B-grade housing, B-grade neighborhoods, people who want to just raise their family simply and easily. It brings a higher return to me, but also it solves a housing problem. Right? I mean, you as a developer understand distinctly how the whole field, at least in California in particular, because of the cost of building has gotten so high, they've overbuilt the luxury end. In order to maximize the developer's net income or net return.
Exactly. Yeah, they're bigger. Any way you look at it, on the nicer, prettier properties, there's a bigger profit spread. There just is. And so we took that, make less off each and do volume. Most builders out there, and it's starting to change some, but builders are not investors. They're builders, and they want to make the most that they can. And they're also focused on retail buyers. Me and you are going, and we want to live here, and this is pretty, and it's got this nice amenity. So I get it, but that's the retail mentality. Since we kind of fell into it by default, Christine, we're like, well, we always did bulk foreclosures, buying them, fixing them up, either renting them or selling them, working with investors. And when we started to build, we just had that same mindset. We said, well, I don't want to work with retail buyers. I did that in the very beginning of my career in Bakersfield. I'd buy, fix, and resell HUD foreclosures to FHA buyers. It did well, but oh my gosh, I don't miss that niche in the least bit. You want to talk about getting shorter and losing hair? It's a tough niche, working with retail buyers. And so I always, being an investor, we started to build them for ourselves. And I just always had the mindset, well, a retail buyer wants a house maybe every 7 to 10 years, but we're investors. We like working with investors. We have the integrated PM. Well, an investor might buy an average of 3 to 8 properties in 2 years with us. And so, that make less, make up for it in volume has always been our model. And plus, we always built for investors, for ourselves, and then now for other investors. So it just was an easy kind of segue that most builders just don't get.
You start talking to that next question of what's the secret sauce of your company. I mean, not only are you like, and I'm going to say the 2 things I've heard you say, then you have to come up with more. So I'm leaving you on the spot. You have to be creative. Okay. So the secret sauce of your company, I can tell so far, seems to be you guys started as investors, so you build for investors.
Yeah.
You guys understand that layer of what it means to build to rent, because you're selling it to an investor who's going to rent it. And there's a specific layer and mindset in there. It's like when I work with real estate agents, I like to work with investor real estate agents, not real estate agents that are primary residence real estate agents. There's a different need for that. Yep. And the second piece is just the fact that you guys are able to keep lower margins, and being able to build in bulk allows you to work with bigger businesses and companies in order to build multiples. What else is you guys' sort of secret sauce? I can think of one more that you mentioned earlier, but I'm gonna let you think of it.
I don't know if I mentioned, the type of property we buy and where. We have good land positions that we bought at the very beginning of 2020, thousands of lots. So we're not buying at the higher prices. We have a good basis, and that allows a builder to build well. Our job is always to build it right, finance it right, and manage it right. One of the best things I think we were able to bring in, we're very lucky. We were partially acquired. A big Japanese group called Suitomo bought into our company about 3 years ago. They are 321 years old. Warren Buffett is very heavily invested in one of their other conglomerates.
Wow.
They're wonderful to work with. They were a great partner to buy in. They believe in build to rent. They believe in Florida. They believe in funding our projects. They've been great partners. And bringing on their balance sheet, first of all, there's been a lot of lack of safety for builders out there that got over their skis, and we've seen problems. We can talk about that.
Yeah, we're going to talk about that.
Yeah, we'll definitely talk about it. And we have no bank debt now. And we have such a healthy balance sheet. We're able to go into mortgage companies and pre-buy mortgages. It's called a builder forward commitment. You have to have a certain financial standing and capacity of how many you're doing, but we're able to buy the mortgages down. We had so many people say to us, oh, we all said it. Gosh, I wish I had locked in 2021 to the rates. Well, we're still now able to buy large tranches of mortgage money and pass that savings on to our buyers of our new construction properties. We're locking in people at an average of 3.75 to 4.25 long-term debt. And for the numbers, when we're still building affordable housing and getting that, it brings things back into focus. If you're going into the higher priced homes and the rates are, above 7%, although overall, I think that's still fair. My first property in Lompoc, California was 9.125, Christina, and I had good credit. So,
it was good at the time.
Yeah, right. So, but that's a big secret. And then management. And we, I did a few thousand fixer-uppers. And the fixer-uppers were older houses in more marginal areas. And those were a lot harder to rehab, a lot harder to keep long-term tenants in, a lot harder to manage. When we upgraded to new construction and went into a higher caliber neighborhood, we were able to get longer-term tenants, less maintenance and repairs, that less turnover, and it made the management easier, honestly.
That's where I was going. I was like, and your property management's easier.
Lot easier. So our whole model: build right, finance right, manage right. Yeah. We bring in all those people, because remember, I'm a old California. I was out in California investing for years. So we have a lot of West Coast investors that come to us. I grew up in the Northeast, though. So I have a lot of Northeast people where they don't like the landlord laws, or it's just too highly priced. They come to an area like Florida where we are, and, they see the buy-ins for single family homes still in the 260s, and they're, with good rents. And so we just fill that where we know where to build, and we're only going to build where there's economic growth, population growth, good affordability, desirability, and healthy supply and demand. And then couple that with management and good financing, we've had a great ability to build some successful portfolios.
And it's for me right now is the time to be buying. So people want to avoid buying because the interest rates are high. And I'm like, no, I'm the other way around.
Yeah.
Right. Like it's an automatic value add. If I can buy something at a higher interest rate, therefore a lower price point. They say marry the property, but date the rate.
Yep.
Right. So I'm dating the rate. I'm going to refinance the thing in 3 to 5 years happily, because if it cash flowed at 7.5%, I'm going to be very happy when I hit 4.5%.
Yeah.
Right.
Yeah.
It's going to make a difference. It's an automatic value add, like rehabbing a property, adding square footage, right? Buying something that is new built so that it automatically is stabilized and attractive, right? The next automatic value add is I refinance.
Yeah.
Exactly. Like That's a simple value add, isn't it?
Yeah.
So therefore I'm buying, right? I'm buying single families. I'm buying, I call it the 5 to 50. So I'm buying, I bought 3 this end of last year. In second half of last year, I bought 3 apartment buildings, 10 unit, 14 units, 22 units. They're tiny, tiny buildings. They're relatively easy to manage in my world because I'm very familiar with that asset. But I'm buying them because that market, the multifamily, got distressed. And I'm underneath the more industrial sized buyer. I'm underneath Ken McElroy, right? I'm underneath the big boys, right? I'm an okay gal, but I'm not the big boys. I don't have 10,000 doors, and I don't target having.
You don't need to. Yeah.
Right? I'd be happy. I've got about 50 doors now. I'd be happy to maybe get to 500 by the time I've got another decade or 2 under my belt. That might be okay.
Yeah.
Right. Yep. And so I just feel like that there is an automatic space in there in the 5 to 50s where you're not competing. You've got inefficient mom and pops. You got a high interest rate, and the multifamily market was hit, right, in this last 2 years.
Yes.
So our window's closing. But when you talk about new builds and you talk about having a stabilized interest rate from the beginning, you're buying what you're buying, and it's going to continue to work.
Yeah.
Like you got to have a much faster stabilization process than I have when I'm buying my little units.
Sure. Yeah. But again, there's a trade-off. Your buy-in's probably a little lower, and there's always trade-offs to any investment, but the goal is you have a destination, what's going to get you there. And there's different niches that'll get you there. The niche I started with got me part of the way, and then I passed the baton to a new niche. Yeah. But the niches we're describing can both work. There's more than one way to seize the victory of what you're trying to do with real estate investing. That's what I've learned. But what I've learned is when you commit to a niche, follow through with it, but also have a guidepost of, like you do with your circle, of someone who's been there and done that. That when we first started building new construction, we got with people that had just been dabbling in building new construction rentals on and off for years, and just learned so much. And that was really important to saving a lot of headaches. You still had lessons, of course, and you will, but that really helped speed up the process for sure.
So I have a side question, and then I want to jump to what's happening in your industry. My side question is, when people invest with your company, right, your 1,000 investors, are they buying a property from you and then you're property managing it for them as a version of turnkey, or are they investing in your developments themselves?
Individual. We do. We don't have any funds right now. We used to have some funds, but now we found that there was no one really at our scale offering new construction rentals to purchase and be direct owners. There's lots of funds out there.
That's why I'm asking the question. Because the last one I know who did that went out of business. So therefore, I'm looking for a new one.
Yeah.
I'm looking to be able to recommend a new one. Keep going, Jim. Sorry.
No. I mean, and so, yeah, we provide the property and the financing and the management. The management is optional. Some people like to manage their own properties, but we always offer incentives. We usually give the first 2 years of management. The monthly is waived, but that's just totally up to you. Some people, as you know, I've managed my own properties for 25 years. Great. But we will provide the build, and I guess unless someone's paying cash, 95% of people use our financing, because why wouldn't you at the rates that we're giving? And so that's what we do. And I think that what we do too is we deliver finished product without involvement. And let me explain what that is. So, you come to me and say, Jim, I want a duplex in Ocala, Florida, right? Well, we're going to figure out which one looks best for you, the locations and stuff, go through the pro forma. Okay, I like this one. Well, we're going to deliver you a finished product, right? You have to put up a deposit that's refundable, but you get a finished product, pre-qual for the loan, boom, you're done. What a lot of people were trying to do, Christina, with build to rent, and they got in trouble, was they were, okay, you're going to come to me, okay, I'm going to sell you a lot, then I need you to go get a construction loan, and then we'll build it, and then good luck, you're on your own, right? So there's no financial incentives, there's no management options. where people got in trouble was they were overpaying for that lot, for example, that I was selling you. And then secondly, these builders took on too many jobs like this. And now all of these people got builder lines. They got these builder loans, and they weren't here. Like, so let's say you're in California, you're not here. And so all of a sudden no one was checking on the builder. They were drawing off of it. They overdrew, they were behind. And now, Christina, for example, unfinished product that you had to get involved in, again, buy your own lot, get your own construction loan, which is tedious and then dangerous. There's hundreds of properties in Southwest Florida, for example, that builders went under with these people now with half-done properties and over-leveraged construction lines. It's very sad and could have been avoided.
Yes, I've seen it. I've seen it through an associate of mine who was in Florida doing it, building from a distance, ended up with half-built homes on multiple lots, and it was a pain in the ass, to say the least.
Yeah.
And I've seen it more than once. I have another client I can think of right now that was doing rehabs versus build to rent, again, from a distance, multiple of them, same contractor, and it imploded. And it's just, I travel a lot to my properties, and I've gotten recent feedback about, Christina, you're the only owner I see this often. And I'm like, okay, well, maybe that's just, maybe that's my trauma. Maybe it's being in the industry for 35 years.
Yeah.
Maybe it's my wisdom.
Yeah. That's what look, when you're, man, I remember I left Bakersfield, Santa Barbara years ago, and I was trying to manage. I thought, gosh, I've done over 100 properties in Bakersfield. I know everything. Well, I became the freshman real quick when I was trying to manage rehab projects from Santa Barbara, California to Jacksonville, Florida. Yeah. And so what I always tell people is either be very diligent like you if you're going to be hands-on, or have someone that's going to give warranties, guarantees to that. And that's why, new construction was such an open invite to a lot of people, because when they can look us up, when we give guarantees, when they can see we've never failed on delivering a build, like that can give safety. So I think there's two great options here. Just which one are you able to work within?
Well, I think ultimately, the optimal is somebody like you who actually knows how to finish a project and has the investor mindset. So understands that every day is $1 lost.
Yeah.
Right. Versus, every day is I was able to get my crew over here instead of over there, and over here instead of over there. Like, from the contractor's point of view, it makes sense that you're sometimes spreading your crews thinner in order to maintain your business. I get that. But every day there isn't a crew at my property is money I'm losing out of my pocket. Right. Whether that's an opportunity cost, a holding cost, an actual note that I'm paying on, a loan of some kind. I've had properties that cost me $500 a day, $16,000 a month to hold up. I want a freaking crew there. You don't understand. Your crew costs less than my holding cost. Get your backside to the, so there's that. Now we're right up against what I think is an important thing is you said earlier that there are companies that have struggled, that have failed in this and Florida is a particular sub-market. And I'm aware that Florida was, in the 2009 recovery, it was much slower to recover. It was a good 4 to 5 years behind in recovery because it's a judgment state. So it was stuck longer, which in a way is an advantage for investors because now prices were repressed for a longer period of time, blah, blah, blah. So tell me, what's the current in your industry in Florida, and what are you seeing, and why did some of these companies fail?
Well, the builders failed because two things happened. They did not do their numbers wisely. And some of them, when the pandemic hit and there were, we had the whole supply chain issue, there was material price increases that had to be called on any builders from small builder all the way up to the nationals. And, a good builder will either say, we have to do this. We can still get you in the best pricing, but here it is. It's a zero sum, gain for us, but we got to get it built right. And if not, we can fund your deposit. And we had to do that. It was uncomfortable. We had a lot of existing clients, but they saw, when you went through the numbers with them, they saw this was an international situation. Yeah. And there were some builders that just tried to put their head down and say, well, no, we'll try to figure out how to build it. And so sometimes I think the intention was good, right, but they tried to cut corners or even say, well, it'll work itself out. And that's not how the numbers work. And so their intention, some of them, their intention was to do good. And it really absolutely backfired and did the opposite, left people with half-built properties now going into default on construction loans. Mm-hmm. Others, I think they just were trying to get what they could get and just walk. And so it was a very short, nearsighted plan for builders. And so, there's been a lot of builders who were doing what we did. I'd say there's 60% less now doing that. And they were taking on too many orders too that they couldn't deliver on. In Southwest Florida, for example, it was a hot area, which meant you couldn't get materials even more, and you couldn't get, it was harder even more to get subcontractors. Mm-hmm. So that's kind of what happened. That, and from what we're seeing in certain markets in Florida where there's been cooling, it was the emotional markets. There was so much, Christina, of the houses said you don't want to build, like, it just, they're beautiful, mm-hmm. great amenities, great areas. They don't cash flow. They looked a lot more attractive at, rates of 3.5, 3.75 compared to 7 now. And so the numbers don't work for a retail person or an investor. And so those have a glut to them. Where we're sticking to is, where is there still job growth and where is it affordable? So like one of our main areas of Central Florida, the greater Ocala area, we're still putting starter homes on the ground for in the 260s, 270s with great rents, and sometimes duplexes for under 400. So that's less than 200 a unit. And that's new construction, high demand. So there's still markets. Again, we look for affordability. We look for job growth. We look for where the population's still growing. I could care less about big and pretty. We want safe. I think, as you know, and some people have watched my videos, my famous thing is I like to video myself walking down one of our neighborhoods at 10 o'clock on a Friday night. Because I was one of my first mentors. If you can't walk down the road at 10 o'clock on Friday night, do you really want to invest your money there? And I've gone against that rule, Christina, and for me, it's never worked really well. Or at least a lot more involvement to try to get it through.
My first apartment building, I should have done that.
There you go. Yeah, because and I'm like, okay, so anyway, that's just coupled with the affordability that we look for.
It takes me back to, like my mentor said, a good property in a good neighborhood with good tenants. Like you don't need to be complex about it. You actually do better in a B grade. Some might say B minus, but as soon as you get down to the C's and D's, I've owned them. My judgment comes from experience.
Yeah, mine too.
Not from hearsay, which is I understand the complexities of those properties, and those are not my favorite properties. I will buy a B minus. I absolutely will. I'm happy to do that, especially in a neighborhood I see as regentrifying. I will intentionally enter into a neighborhood like that, but it is with a long-term scope and a long-term play, and it's a B minus, and it's not a C, and it's not a D, and I don't have gangs dealing drugs in my parking lot. Real story. I don't have a guy dealing drugs out of his unit, meeting our property manager with a gun at the door. Real story. Like I just don't have those things going on in these buildings that I'm looking at now, which is just complex. It just becomes complex.
Yeah, and as you know, Christina, turnover is expensive, and so in those areas where I always would get promised in the C and D neighborhoods this way higher cash flow, like, oh, the 1% rule, we'll kill that. We'll almost get you the 2% rule. I would give that back and then some, not only in financial resource, but also time and headache and concern. And I'm going, wait a minute, something's amiss here. As you said, why don't I just what I've said now is for my sons who are getting into investing, I will always sacrifice some cash flow for a better quality property and look long-term. Kind of like what you said, your mentor said, good property, good area. So like for us with the new construction now, we say we do A properties and B neighborhoods. We have established neighborhoods built in the 60s and 70s, and we're putting new duplexes or new single families in there amongst them. So it's an A property in a B neighborhood. And that's kind of our model now. And it's, I own way less property now, Christina, than I used to, because I was, getting the 100 house club and and I way past that. But what was it actually providing me back every month? And when I looked at that, I was like, oh my gosh, so I have more cash flow and more equity now than I've ever had, and I have way less properties. So what does that tell you?
Yeah.
It's a big lesson that I try to pass on to, people close to me, my kids and stuff. Like, you can try that route, but here's what happened for me.
Right. And you're not the first person to say that, right? I mean, I'm into conversations with a gentleman named Randy, who's in another mastermind I'm in, and he's the same thing, right? Like I have more doors, they're more efficient. I've intentionally repositioned the portfolio from having the number of doors I had to the number of doors I have now. There's better returns on the properties I own and the quality of properties I own, not the A's, right? We're not buying the luxury, and not the CDs, which have all the problems, the headaches, and the chronic drains. That sort of middle segment, at least, maybe we're drinking our own bathwater, but just to repeat, like that B grade property with that B grade neighborhood with B grade tenants, and an A grade property that you just built.
Yep.
Right. Let me ask you this question: Can you build per square foot higher than the sales price is in those neighborhoods? Are you building more? Is your cost to build higher than the per square foot for an existing home, or less than per square foot for an existing home?
For the type of construction we are, it depends on the property. It's not fair to compare one of our new starter homes to one of those expensive emotional properties, because of course we could beat that. What I see is we're normally able to build, since we're doing more workforce housing focus, we can build at a lower price per square footage than average builders,
right,
or average cost. Okay. But to be fair, that's only because when you're averaging all the other properties, the more expensive properties and such, those emotionals that have got overbuilt, that's pretty easy to outperform, if that makes sense.
Okay, that's fair. That's fair. When I was a rehabber, one of the tricks that we used to do as a rehabber was, if you could build your new square footage at less than the existing sales price per square foot, that was an automatic value add as well.
Yeah, absolutely. And I used to follow that. And look, again, I rehabbed over 2,000 properties. That was my thing. And so it is a great method of growth. But what I like the cleanliness of new construction. And I cannot normally beat the price of a refurbish, a similar house, but then both have their trade-offs. Again, I own both, but the one has a lower basis, I think, but the other has a different longevity play of less maintenance and repairs, normally less turnover from what we've seen on that. The turn costs are lower when it does move off on average. So there's some trade-off, but again, both can get you where you want to go.
Yeah, I agree. There's so many ways to make money in real estate. Lots of people I know, there are some people I know, not lots. There's some people I know who only like the A grades. That's all they want. That's all they want to buy into. That's all they want to deal with. I only want to deal with the best tenants. I don't want to deal with the hassle of other quality of tenants. The A grades leave the units nicer, da 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 da. And I'm like, I hear all of that. And I get that as a sort of an older, like, legacy portfolio, the one I'm trying to build right now. I can understand why that's valuable.
Yeah.
I still look at that and I go, but I don't know that I need that much peace of mind if I have a quality management company that's in the way, and I'm knowing how to manage my managers, and I'm comfortable with managing my managers. And I still like traveling. I still enjoy traveling to Tulsa and Indianapolis. I still like my little 24, 48-hour turnarounds. I don't miss much of my family time, but I get to see everything I need in a very short, efficient period of time. So tell me, this is a question we didn't necessarily discuss, but it's on the list, which is, we're both in the collective, and the collective is basically a mastermind that is for higher net worth individuals, people with a longer history in investing, and lets us hang out together and have these conversations this way. Like, this is what I have found. This is what I have found. Let me mentor you on this. Let me mentor you on this, because we're not experts in everything, right? We can't be. And if we want to move something inside our portfolio, it's great to have that collective together for us to be able to mentor each other, share with each other, and just be honest. Like, 2009 sucked. Let's be honest about that, right? So, but part of what we're also doing is that we're building our basis for financial freedom.
Yeah.
What does it mean? So what does financial freedom mean to you? I know what it means to me, but it means something very subtly different to every individual. What does it mean to you to be able to be financially free?
It's such a pondering question, right? That's been brought up from my early days of my first masterminds of, and
Yeah, that's right.
and I think that, the definition is simplified down for me. Financial freedom is the how. And let me explain that. So it's how do I have to live my day? And so, let's look at today. I'm working from my home office. I got up this morning, I went up to the beach, and then came back. Our younger kids were down, had a great time, made coffee for my wife and I. We drove them to their little school in downtown St. Augustine, stopped at another place, came back, had a lunch day. My son, who's a fireman, came over. We were hanging out, and then I got to have a great conversation with you, right? And I talked to one other client. That's the how. See, how I'm living my day. And so financial freedom for me is I have money coming in, but sometimes there was times where I had money coming in, Christina, and I was in more shackles than I've ever been. I was so overwhelmed, email at 5:30 a.m. and at 10:30 at night and call. And so for me, financial freedom is have resources to be with the people I love, taking the adventures I want to take, and being able to, like, how am I actually living each day and week and season? And that's what financial freedom is. Having the resource, yes, but also being able to enjoy, not saying, oh my gosh, Christina, you want to catch up on a phone call? I can talk to you in 3 weeks. That sounds exhausting to me. So there's that balance there of those things. And I know one of my Australian friends, you like this. He said, well, it's pretty simple, mate. I like to be able to go into a restaurant and not look at the price of what a sushi roll costs. And I'm like, well, that's pretty simple. And I agree with that too, where I'm not like, oh my gosh, let me figure out, can we order this? And going into a restaurant and ordering what I want to order. And so I don't know if those are the best definitions you've ever gotten, but that's kind of something that I ponder on, and something I try to really hold to.
I'll tell this story. It's super short, and then we'll bring it to a close. So my daughter's definition of financial freedom is sushi. I'm just telling you, she absolutely relates to that. So here's how I know this. So we were in a home I had rehabbed, and we were walking around the house, and she was like, Mom, you own this? And I'm like, yeah. I do own it. I've rehabbed it. She's like, why don't we live here? I mean, come on. And I just looked at her and I said, you'd have to give up having sushi every twice a week. She's like, oh, well, forget that.
Yeah. And all right, I don't know if you're still near Santa Barbara, but the Santa Barbara sushi was unbelievable. So
there you go. No, I'm not near Santa Barbara, but given my daughter's love of sushi, maybe I need to get my backside up there. You can send me.
Careful, because there's really good sushi up there. So
I
love that. But isn't that, because I've even seen people where they have maxed to the hill of a ridiculously large house that they hate, or other things, or even I know a couple of people that bought planes too early and they didn't need it. And it was I can't actually go somewhere because this is costing too much. So it's, how can you continue to live your life with the resources you have coming in? Your sushi example is perfect for that.
Yeah. I call it right sizing your life. There's a right sizing to your life financially, because I do that with my clients all the time, even though we talk about real estate. Right, as a registered investment advisor, and I talk about real estate, how you develop your portfolio. What does it mean to design your portfolio from the top down? How do you build your life around that? I call it right sizing your life. You right size your life, you get the value out of the dollars that you have. That's the actual return on equity, is the life you get to live.
Yep.
What does that mean? So right sizing your life, given the life size of your portfolio, gets you to financial freedom so much faster than the concept of financial freedom is this over here, this size house, this size. All right, Jim, thank you for tolerating me. I so appreciate it. Thank you for being on my show. This is Christina Suter with Real Estate Breakthrough. Jim, why don't you give people some information on how they can get a hold of you and or invest with you?
Yeah, if you want to hear more about our company, just go to southernimpressionhomes.com. You'll learn all about build to rent, what we do, why we do, how we do it. And you can get a free download of our best-selling book. And
Jim, can they also just look you up? JIMSHEILS.
Yep. Yes. You'll see we have 2 best-selling books on Amazon at Barnes and Nobles, and about family and about real estate. So if that's any help to you, give it a try.
Yeah, I can see it on both sides. I can see the family on one side and the passive income playbook on the other side. It's really perfect. And again, the value of financial freedom is being able to how you choose to live your day. I agree.
Absolutely.
100%. All right. Thank you. Tune in next week for the next show on YouTube, Roku TV, Amazon TV, and a variety of podcast stations and platforms. Christina Suter, Real Estate Breakthrough.